In today's lesson, I'll talk about one of the most important topics in your entire Forex journey, which is the risk management. If you have been following me from day one, by now you already understand charts, trend lines, support and resistance, and candlestick patterns. But you see this particular lesson, the risk management lesson, this is one that decides whether you survive in the Forex market or you just blow your account. So let's dive right in. What is risk management in Forex? Risk management simply means controlling how much you lose when a trade goes against you. If you have a trading capital of, like, let's say $100, and you enter a trade, if the trade goes against you and you lose all your $100 capital, that means you didn't apply proper risk management. In other words, risk management is the measure you put in place to protect your trading capital. Every trader wants to make money, but only smart traders plan how much they can afford to lose. The truth is, you can't control the market, but you can control your risk. It's like driving a car. You can't control the road, but you can control your speed. That's exactly what risk management does in Forex trading. Someone might ask, why is risk management important? Let me explain. No matter how good your trading strategy is, losses are part of trading. The goal is not to avoid losses completely, but to make sure your losses are smaller than your profits. In fact, your profit should be far more than your losses. Okay? Without risk management, even the best strategy will fail you. Okay? The best strategy will fail you if you don't apply risk management in your trades. With proper risk management, even a 50% win rate from your strategy can make you profitable in the long run. It's not how many trades you win that matters, okay? It's how much you lose when a trade goes against you. If you take, let's say, 10 trades in a day and make profit on each of the 10 trades that you took in a particular day, and on the next day you take one trade that closed on a loss, and the loss you made on the next day wipe out your 10 profitable trades you made on the previous day, that means your risk management is extremely very bad. Let me share some risk management techniques that will help you protect your trading capital. The first one is the 1 to 2% rule. 1 to 2% rule. This is one golden rule every trader should follow. I can't even lie. It is one golden rule every trader should follow. Never reach more than 1 to 2% of your account balance on a single trade. You can write what I just said down so that you can always remember it. So if you have, like, let's say $100 account, don't reach more than $1 to $2 per trade. If your account is $1,000, your risk per trade should not exceed $10 to $20. This approach keeps you safe from blowing your account, and you can still have capital to trade the next day. Okay? The second risk management technique is using stop loss and take profit on all your trades. Your stop loss is like a seat belt. All right? It automatically closes a trade when price moves too far against you. And your take profit is your target. It locks in your profit when the price hits your desired price level. And again, never enter a trade without a stop loss. You might get lucky once, but one bad move can wipe out your entire account. I repeat, never enter a trade without a stop loss. You might get lucky once, but one bad move can wipe out your entire account. Let me show you on the chart how to place stop loss and take profit. So to set your stop loss and take profit, the first thing you need to do is to select the asset you want to trade. So I'll go for Euro USD. There's no Euro USD here. Let me add it. I'll click this button and I'll go to Forex Major because Euro USD is under Forex Major. Euro USD here. I'll just click this add button beside it. And once I do that, I'll go back and on the quote page I can see Euro USD there. So click on Euro USD. I'll go to chart. So when you get to chart, for you to set your stop loss and take profit, you first of all need to enter a trade or a pending order. So I'll just go ahead and enter a go for buy, go for buy. Okay, accept. Okay, so I'll go for buy. So I just bought the asset. For me to enter the take profit and stop loss for this particular trade I entered, what I just need to do is to click on the trade. This dotted line is the price level I entered the trade. So I'll click on it and click on it to go down. You see this pop up. You see close, you see SL, you see TP. SL means stop loss, TP means take profit. So to set your stop loss, you click SL. When you click SL, immediately the SL line will come out. Then you drag it to where you want your SL to be. Okay. Then for take profit, you click TP. Then the line will come out here. Then you drag it to where you want your TP to be. And once you're done, make sure you click this arrow button. If you don't click this arrow button, this take profit and stop loss will disappear. Not take effect once price reach that level. So I'll click this button right here. Once you click it, you see this message. Then you come down here and click modify. Right? Once you modify, you see this done button. So the take profit and stop loss for this particular trade has already been set. So this is how you can set take profit and stop loss on any trade on the phone version of the MetaTrader 5 platform. Always plan your risk to reward ratio before placing any trade. Risk to reward means the ratio of your target profit to your risk amount. A good risk to reward ratio should be 1:2 or higher, meaning if you're risking $1, you should be targeting to make $2 or more. 1:1 risk to reward ratio is still okay, but never go below 1:1 risk to reward ratio. Okay. The third risk management technique is position sizing. Position sizing. Now, this is where most beginners go wrong. Okay. Most beginners don't know the right lot size to use on a particular trade. The lot size you use determines how much you are actually risking. Okay, let me quickly show you on the MT5 chart how to calculate your lot size using what I call pending order trial and error method. You learn how to set your lot size based on the amount you want to risk using a pending order. That's what I mean by pending order trial and error method. So guys, let me show you how you can use the pending order trial and error method to calculate the right lot size to use on any amount you want to reach on any particular trade. First thing first, for you to be able to calculate your position size, you must know three things. First, where you want to enter the market, then where you want to set your stop loss, and where you want to set your TP. Let's assume I want to set my stop loss somewhere here. Let me use the line button. Let me use the line tool to indicate. Line tool there. Let's assume I want to enter. I want to set my stop loss somewhere here, and I want to set my take profit somewhere here. Okay, and I want to enter at the current market price. This is the current market price here. So the first thing that you need to do, you have to be very fast if you're using the current market price to calculate your position size using this pending order trial and error method. So the first thing I need to do is to first click on this pending order button right here. Then I'll take the pending order. I wouldn't mind the lot size that is there. I wouldn't mind. I won't be bothered. I'll take it to the current market price where I want to enter the market. Then I'll come here and click the stop loss and take it to where I want my stop loss to be. Then if you look here, you see the amount you want to risk, right? This is $162. And I just want to risk $20. So what I just need to do is I have to reduce this lot size of 2 because it's the lot size. If I use the lot size of 2 and my trade hit my stop loss, I'll be losing $162. So I just want to lose $10. What do? I'll use try and error to change this number so that I can only lose $10 here. So I'll come here, I'll delete it, Then I'll type 0.5. When you type 0.5, immediately the price will change. Okay, I'm seeing 40. No, I still need to reduce it further. Let me go with 0.1. Let me go with 0.1. Is 0.1. Here I'm seeing $8. That means I can see 0.12. Okay, I'm seeing 9.72 is almost $10. So I'll now use this lot size to enter this trade. Okay, this is the lot size I have to use to enter a trade, so that if I set my stop loss at this level and price get to my stop loss, I'll lose exactly this amount, right? So this is an easy way to calculate position sizing using the pending order trial and error method. So I don't want to sell pending order, I want to enter direct market execution. Why I say you have to be very fast, because price has already left the place I placed my entry. So you have to practice this more often so that I can be very fast. Okay. So if I enter right now and still use currently where the price is and still use the same loss, you see that I'll be risking $13. So that's why you have to be very fast. Okay, especially if you're scalping, as if your take profit, if your entry and your stop loss are very close to each other. Okay, this is how you can calculate your lot size based on the amount you want to risk using the MikoFx pending order trial and error method. It's very easy for beginners to understand. The fourth risk management technique is emotional control. Even with a solid plan, emotions can destroy your risk management. Don't revenge trade. Don't increase your lot size after a loss trying to win it back. Trading is a game of discipline, not luck. Okay, trading is a game of discipline, not luck. Your emotions should never control your lot size or your entries. Stick to your rules, be patient, let the setup come to you. So in conclusion, risk management is not just a trading concept, it's a survival skill. Okay, if you manage your risk properly, you always have another chance to trade again tomorrow. So as you continue your MikoFx 30 days intensive forex training, remember this rule: protect your capital first and profit will follow. Okay, in subsequent lessons we'll talk about trading psychology, how your mind can either make you or break your trading journey. Until then, keep your risk low, stay consistent and trade smart.